A very good evening to you all, friends. I'm Sanjeev Singhal, Central Council member and Chairman, Auditing and Assurance Standard Board. It's indeed a pleasure to share with you that today is the 100th unstructured, structured CP program. This one is unstructured one for this council year 24-25. So in 2 months' time, it is the 100th program, out of which 82 programs were on bank audit, 79 on physical mode, and 3 on the virtual mode. And this is a part of the series of now key consideration in audit of listed companies. So far, we have done 4 programs on this series. And today is the 5th program, Audit of NBFCs. Before I talk about the topic, let me also share with you, friends, that both the helpline on bank audits, and as well as the helpline on audit of the corporate and the non-corporate entities is open. We have 50 experts each in both the helplines, and you can ask your audit-related questions in those helplines from our experts. There is no fee for that. And normally we try to revert within 24 hours to 48 hours. All over the world, this is the largest helpline which can happen because about 40,000 branches are there and more than 25 lakh corporate and non-corporate entities are there. And we have addressed every possible query as long as it was on audit. So friends, today, as I said, is a part of the series of the audit of listed company, because listed companies audit season is going on. And today is a very specialized topic, audit of non-banking finance companies, because non-banking finance company have certain peculiar characteristics. Even their, liquidity type of an arrangement of the balance sheet and the RBI requirement, the capital adequacy ratios, etc., and the Schedule 3, etc., have separate consideration. So it's an altogether different topic. And now all the listed companies which are NBFCs are on Ind AS, unless they are a banking company, of course. If they're a part of a banking company structure, they also prepare their financials on AS for the purpose of consolidation. And to deal with this topic, we have 2 very esteemed friends, CA Dr. Chinnaswamy Ganeshan. I know Ganeshan now for over a decade, rather more than a decade. He has immensely contributed to the profession, whether it is ASB or AASB or in various other capacities. He's one man, probably who started taking sessions for ICI before I started taking sessions. I started taking sessions in 2002. That was my first session that I took for ICAI. So Chinnaswamy Ganeshan is a stalwart and very well-read, well-traveled, and very well experienced. Thank you, Ganeshan, for sparing your time once again. And then we have CA Vikas Kumar. I know Vikas from last several years, but my first interaction in detail happened with him when he was a panelist at the recently concluded 2-day conference by NFRA in Delhi. And I had the opportunity to hear Vikas, and he shared his view in great detail. He was a panelist along with our president, Ranjit Agrawalji. And Vikas comes from a firm which has a long legacy in India. TR Chadda is the CEO of the audit practice. And again, a person who is well-read, who is technically well-equipped. So thank you, Vikas. Thank you for spending your valuable time for being with us today. And we have 2 experienced members as our moderator, CA Vishal Goyal and CA Vinay Rellan. They will be moderating the session in this sense that introducing our speaker, and also whatever questions are asked by participants, they'll be raising it to our esteemed speakers. So my thanks to all the 4 esteemed members of our institute, and above all the participants. In unstructured CP hour, it is only those people who will join who have a real interest in learning. And it's been our experience that a lot of members are interested. That is why we are continuing with these programs. 100 program in 2 months is by no means an easy task. And thanks to the entire AASB staff led by Anil Lalji, who has been organizing these programs one after the other, talking to various speakers, talking to various moderators, and of course, our participants. So thank you very much. And may now invite Vishal Goelji to kindly take the session forward. Thank you.
Thank you, Sanjeev sir. Good afternoon, sir. Good afternoon, everyone. I see Vishal Goel. Welcome you all. Welcome CA Sanjeev Singhji, Central Council member and Chairman Auditing and Assurance Standard Board of ICI. CA Vishal Doshi ji, in his absence, Vice Chairman AASB. Today's esteemed speaker CA Vikas Kumar ji and CA Dr. Chinnaswamy Ganesan ji, and my co-moderator CA Vinay Relan ji, and all participants. I welcome you all in today's seminar on key consideration. Now I introduce all participants about our esteemed speaker CA Vikas Kumar ji. CA Vikas Kumar ji is a qualified fellow chartered accountant having more than 30 years of post-qualification experience. He is a partner with TR Chadda and Company LLP since 1996, having more than 27 years of experience, and is CEO of the firm. He has extensive experience in statutory audits, forensic audits, business advisory services, etc. in various industries. He is specialized in financial service sector and extensive experience in audit of large banks, NBFCs, etc. He has been involved in statutory audit of State Bank of India, Bank of Baroda, State Standard Chartered Bank, Tata Capital Housing Finance, PNB Housing Finance, Equitas Finance, Small Finance Bank, etc. In addition, he has been involved with various other banks for internal audit, concurrent audit, etc., including ICICI Bank, RBL Bank, Citibank, IDA Bank, etc. He is a regular speaker and panelist at many conferences and seminars of ICI, SEBI, CAG, etc. on various topics, including accounting standards, banks, NBFC audit, forensic audit, etc. He is member reviewer of following committees of the board of ICI: technical reviewer of quality review board constituted by ICI and Government of India, technical reviewer for best presented accounts in India and South Asian Federation of Accountants, member of the group for revision in guidance note on audit of banks, member of the group for revision in long form audit report for banks. He has also done various inspection and special audit on behalf of SEBI, RBI, IRDA, etc. Now I request co-moderator CA Vinay Relan ji to kindly introduce and to proceed further.
Sir, you are on mute.
Sorry, sir. Sorry. Namaste, friends. I, CA Vinay Relan, thanks CA Sanjeev Singhji, Central Council member and Chairman, Audit and Assurance Standard Board of ICSA, for giving me the opportunity as moderator of this program. Respected panelist, my co-moderator CA Vishalji, and member present in the audience. Today, our second learned speaker is CA Dr. Chinnaswamy Ganesanji. CA Ganesanji has 35 years of experience in the area of auditing. He is the lead partner for many Indian and multinational companies, carried out audit and advisory on international financial reporting, taxation, due diligence, and other assurance services. He started his practice as chartered accountant in 1988. Dr. Ganesan was in personal practice till 2005. He then served as a director in audit with Love Look and Lewis network of PwC for 6.5 years. Served as audit partner of BSR and Company LLP network firm of KPMG for 6 years. Both are considered as Big Four accounting firms globally. He is presently founder CEO of Chinnaswamy Ganeshan and Company Chartered Accountant, and also one of the senior partners of Messrs CNGSM Associates LLP, Chartered Accountant, Chennai. Dr. Ganeshan is specialized in financial reporting, including Ind-AS, IFRS, and US GAAP, company matters, audit, and taxation, and was conferred honorary doctorate for his extensive contribution to Ind-AS and IFRS by the renowned foreign university. He is the recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence for his contribution in the field of financial services. Dr. Ganeshan has presented 1,400 papers at various seminars, workshops, and conferences, both in India as well as overseas, on these specialized subjects. He has associated 80 plus companies on Ind-AS, IFRS in India. He transitioned and authored several books on financial reporting and Companies Act 2013. Dr. Ganeshan is closely associated with Institute of Chartered Accountants for past 20 years. His guest faculty for all the 5 regional councils. He was co-opted member of the Accounting Standard Board of ICIA, Henderson Implementation Committee of ICIA, Auditing and Assurance Standard of ICIA. Dr. Ganeshan is advising many board of Indian as well as in multinational companies and was independent director of Railtel Corporation of India Limited, a mini Ratan public sector company undertaking under the Ministry of Railway. He is presently an independent director and chairman of Audit Committee of Pure Vaishya Bank Limited, a leading scheduled private sector bank. He is also independent director of Belstar Microfinance Limited, a subsidiary company of Muthoot Finance Limited. He is presently co-opted member of Executive Committee of Institute of Director Chennai, Board of Study of Department of Commerce, University of Madras, Board of Study, the Department of Commerce, Sangraja College of Madurai. We all welcome Dr. Chinnaswamy Ganeshan in the webinar. Now, we request today's eminent speaker, Vikas Kumarji, to start their deliberation for today's topic. Thank you. Over to Vikasji.
Thank you so much. Thank you so much, sir. First of all, thanks to CA Visalji for my introduction. And friends, I would like to start with thanking Auditing and Assurance Board and especially Sanjeevji for inviting me on this webinar on which we have to talk on a very special subject, which is NBFC. And this being the 100th one, which we have learned now. So it's a special privilege for me and Dr. Chinnaswamy to address that. I also understand, friends, that this is the first one on NBFCs. So Sanjeevji was telling that there have been a large number and significant numbers on banking, but this is the first one NBFC. But I believe and understand NBFCs are really, really important in the entire ecosystem in India at present. May not be as large at banks, but not as small as compared to banks, considering the number of webinars which we have done for banks and not for NBFCs. So it is a huge size. I understand it is more than 40 lakh crore of AUM, which is there with NBFCs all over India now. And NBFCs plays a very, very important role. And you can see nowadays RBI also has been very, very focused on NBFCs, and there have been a lot of regulatory actions as well happening. Recently, you might have seen even for JM or IFL and other cases where they have taken regulatory action. So the auditing in the NBFC space is becoming very important and critical. And the auditors which are associated with doing audit of NBFCs, though the number of auditors will be less because not having much branch audits, but the role of the auditors who are involved with NBFCs will be as significant as those for the banks. Having said that, the today context which myself and Dr. Chinnaswamy ji have discussed is that I'll focus more on the advances related aspects of NBFCs as well as some key aspects of HFCs and some generic things, and all other critical aspects will be taken care of by Dr. Ganeshan. So that is how the structure is going to be, friends. And at any point of time you feel that you need to discuss on any of the issues, of course, there is a clear question answer. So you will be free to discuss all your questions and queries at that point of time. You might be aware, all the auditors who are involved with the audit of NBFCs, that RBI some time back had come out with the clear levels of NBFCs based on which those have to be defined. So they have defined NBFCs as base, middle, upper layer, and top layer. So if there is any NBFC which is not deposit taking and less than 1,000 crores, that is called as base level. If there is any NBFC which is deposit taking or more than 1,000 crores, that is considered as the middle level. Upper layer is something which is defined by RBI. At least top 10 will be definitely defined as upper layer, but RBI can define any more, and there are 16 NBFCs which they have defined as upper layer. They have not defined anyone as the top layer at present. So that is how they have bifurcated the NBFCs, and they have also put various rules and regulations accordingly with respect to the those NBFCs to adhere. And they have also been coming out with very clear norms and master directions and circulars with respect to what are the key aspects which these NBFCs have to take care of. So the last one, which was a comprehensive one master circular, which came in the year 2023, based on which this entire working is to be done. Before I go on the loans and advances specifically for NBFCs, when we start audit of any area, I think we have to start seeing that what are the policies which is in place. In fact, RBI focuses a lot for NBFC because this is on the getting money and lending money, so that everything has to be controlled by way of a policy. And all those policies have to be board-driven policies primarily. It's not something which the management can decide. It has to be a board-driven policies. So when we start the audit of NBFC, we should first familiarize ourselves as to what are the policies which are in place in the respective company. When it has been approved by the board, whether there has been a regular review of those policies or not, what are the latest one, whether it takes care of all the guidelines given by RBI, or in case of, say, HFCs given by National Housing Bank. So all other critical things, whether these are forming part of the policies or not, has to be seen. And some of the main policies, which if I can say, which must be there with any NBFC, which includes like risk management policy or liquidity risk management policy. Fraud reporting is a very critical aspect nowadays. So for fraud reporting, RBI has been talking that they must have a clear mechanism and reporting policy. Credit control, which is of course the main stay of the NBFCs, there has to be clear policy on that. Information technology, because even for the credit or all other aspects in any NBFC, information technology play a very role. So IT and system policy is very important. Similar on the credit side will be very important, will be AML, that is anti money laundering, and KYC policy, which is expected to be there. And as you are aware, for all listed NBFCs, the provisioning is as per ECL, that is the expected credit loss. So there has to be clear defined policy for ECL also. And similarly for asset liability management. So these are the key policies which must be there, apart from various others which is expected and reside by RBI. So, but these are the key ones which should be there. And the auditor is supposed to ensure a detailed review of all of them, to have a walkthrough of all of them, have a clear understanding on all these policies, and see that these are matching with regulatory directions and notifications. And once it is being done at the very start of the audit, it will actually help to design and define the entire plan and the focus areas which are going to be there. Along with policy, the another thing which I always talk and we practice when we do the audit for NBFCs is that we try to familiarize ourselves with the regulators report. For there is an inspection report of all the regulators, in this case like RBI, or in case of housing finance companies by NHB. So those regulators reports gives a lot of understanding, lot of clear knowledge on what is actually happening in those companies, and what are the key things which the regulator itself has been focusing and talking on the respective areas, and whether the respective companies have actually implemented all of them, and where are the companies stand with respect to those reports. Apart from the reports, another aspect which we definitely see and we must focus is the returns which are being filed with the regulators. So there are a lot of monthly, quarterly, half-yearly or yearly returns which has to be filed with the regulators. So whether those have been filed in time, and if you see that what is getting filed, what is getting reported, then it gives you clear understanding when you plan and do the audit as to, okay, this was reported, this is how it was reported, and where are we? Is there any deviation in the same? Or it will actually, even otherwise, it will help you to plan. Those reports could be with respect to the fraud reporting or NPA movement or prudential norms, deposit, liquid assets, any of them, basically whatever they are required to file, if they are filing, this will help you to understand. Third critical aspect, which I believe is important when we plan and do the audit of the credit side or the loans and advances of any NBFC, is on the IT structure, as to how the entire IT structure is framed. In fact, the expectation of the regulators is, or even otherwise from control perspective, is that there has to be an end-to-end automation. Because in NBFCs, the customers are in huge numbers. It is just not practical to have any control either by the company or a review by the auditor unless until the automation structure is very strong and the entire data is flowing through an automation and there is a clear trail on the same. So the understanding on the IT structure and the framework which is there in place in the respective NBFC is a critical requirement and critical activity which must be done in advance before we go in detail to do the audit. And from credit perspective, primarily, when we focus as to what are the IT system, the important thing will be that how the entire asset classification and provisioning is done on an automated manner. On the expectation of the regulator again is that there should be no manual intervention. There should be no need to go and change something in the system to find out what is the actual provisioning required or not required. Though the smaller NBFCs are still not there, larger ones are, many of them are not. But this is what the expectation of the regulator is. So from audit perspective also, whenever we are planning, we must see the entire classification process, how the classification is happening, how the provisioning is happening, how the DPD computation is being taken care of, whether the system itself is actually computing and bringing out the default or not, whether the NPA stamping is happening on a day-wise or not, because you must be aware that RBI came out with that requirement that there has to be a day-wise stamping. It should not be at month-end or quarter-end. It has to be day-wise stamping. So whether the system is taking care of the day-wise stamping or not. Similarly, there is a specific requirement that if for same borrower one account goes bad, other accounts will also be classified in the worst category. So with whether one good, one bad identification and classification is happening or not. Similarly, whether the upgradation of account is happening from the system or not, whether all the regulatory reporting is happening from the system or not. So all the things relating to credit, which helps to find out what are my total loans, what are my total stage-wise classification, what is my provisioning coming, how is the ECL rate getting computed. The expectation it should be automated. And wherever the automation is not there or not up to mark, the role of the auditor is higher. Of course, in automation also we have to see that it is being configured properly, it is being designed properly. But wherever it is not automated, the role is significantly higher. Because then you are relying on those manual computation, then you are seeing those ECL calculations being done manually. Is there any error in any of the formula or any aspect can create a lot of issues. So the work will have to be planned and decide accordingly as to how much automation for the respective areas are there and how much we can rely on that. And especially, as I said, on the asset classification and provisioning process, the end-to-end automation is critical. And wherever we feel that automation should be there and not, we should also bring it to the notice of those charged with governance. So that's the on the IT side, which I believe should be there. Now, going specific on the loans and advances, which is the main role and where I need to focus today, it will start from the credit assessment side, right? So in any case, if any NBFC wants to give loan to anyone, the first thing which they are supposed to see is that how they are actually assessing the credit or doing their credit assessment for the respective borrowers. What are the key things which are defined in their policy, in their process, and whether the company or the people who are there, who are responsible to do that, are ensuring the same. So key aspects which can be seen from that perspective will include, like, very, very fundamental, which is being used everywhere, like the financials of the borrowers. It must be looked upon as to how their ratios are looking, how much their borrowings they have, what are their related party transactions, what is the promoter's contributions expected, what are the promoter's background, that is another thing which must be seen. What is the background of the company in which they are working, which sector, how is that sector working upon, whether that sector exposure is allowed as per the norm of the company, how are the competitors for that company which is with there, how the overall performance evaluation is done, whether the credit check is being done or not. Security is another very, very important aspect, whether what is the quality of the security and how realizable that is. So all these items, including like ALM profile, whether there is a guarantor involved or not, whether the evaluation of guarantor is done properly or not. So all this credit assessment is the first and foremost thing, because if the assessment is done properly, the other things will flow properly. So the auditor should focus, whatever sample you're taking, the focus should start from the credit assessment, right? So what is the policy? How the respective people are taking care of the same? What documentations are there in place? So we always suggest that whatever sampling methodology you have and whatever sample you take, you have to have end-to-end. So starting from the assessment till the last of the classification, you should check for those cases. That is what our thought process or suggestion in this cases will be. So once the credit assessment part is done, the second part is done, that you have sanctioned the loan, suppose, or you are in the process of sanctioning the loan. So what are the areas which the company is taking care of while doing the sanctioning or while doing the disbursement? So before disbursement, if the things are taken care of, you are in a much better shape as compared to when you disburse the money and then you want to take care of certain things. So that will be the second stage after credit assessment, to see that what are the areas you are taking care of at the pre-disbursement stage, right? So critical things in that area could be like whether the sanctions are being done within the power. So the company should have the delegation of authority very clearly defined, who can do what. So whether we are sanctioning the limits within the powers or not. If there is any change in the terms of sanction after the same has been sanctioned, if there is any change happening in those terms, whether it is again ratified by the appropriate authority or not. Because in practical sense, we have seen that suppose there is a committee which is authorized to do this sanction. Now, committee has done the sanction, but the change in the sanction terms is happening a level below or 2 levels below. Then it defeats the purpose, that if the sanctioning authorities are giving sanction based on certain criteria, and if you're relaxing the criteria without knowledge of the sanctioning authority, is it fine? To our mind, it is not. So whether how that process is there in the company, if the process allows, then again that is a question mark, because it should be the only appropriate authority or the sanctioning authority which should be allowed to do these changes. Changes could be of two terms, material, non-material, but material changes must be done only by the sanctioning authority, right? Another thing could be like whatever terms and conditions and sanction terms are there, whether it is getting accepted by the borrower or not. Because you have given them the terms, but if the acceptance is not there from the borrower, tomorrow there could be an issue as and when you want to deal with them. So that acceptance has to be taken care of. And the disbursement can be done only after compliance of all terms and conditions of the sanction letter. So if there are 20 things defined, it must be taken care of. If something again is not being done and you want to defer something or to see that it can be done later on, then again the approval of the sanctioning authority should be in place. So the compliance of all the terms and conditions is again a very critical aspect. Now, before again you disburse the money, another important aspect would be like margin money of the borrower. They are supposed to bring in some money before the lender brings its their share. So whether that margin money is brought in or not, whether entire loan documentation has been done properly or not, properly executed, whether it is loan agreement, whether it is letter of guarantee, whether it is hypothecation agreement, that all has to be ensured in toto. But then another important thing is like loan documents must be approved by the legal experts as well. Another thing we have seen that in case if some loan is sanctioned and tomorrow there is a change in limit or change in the constitution of the borrower, there has to be a change in the loan documents also. The fresh loan documents need to be executed. The old loan documents will not hold good. So that is something which gets missed at some point of time at some of the companies. So we should definitely see and familiarize ourselves on those aspects. Another aspect, friends, we think and we suggest is on the KYC. KYC is again a very, very important element. There's a lot of focus by the regulator, and the whole objective of the KYC is to see that no fraudulent customer or the borrower should be in a position to come and get the money from us. And there should be no money laundering activities which are happening in guise of this loan activity which is there. So KYC process is taking a lot of focus nowadays. And the entire mechanism of KYC and AML should be board driven again based on the policy. And so how this entire policy is getting flowed and being taken care of should be another important aspect in the audit of NBFC, which should be focused upon. You might have also seen that there is a lot of co-lending business happening in NBFC. In co-lending business also, at least few cases where we have been involved on a practical sense, if I talk about, they were relying on the KYC done by the other entity for which they were doing co-lending rather than the NBFC, which has actually given the money as well. So that is something which is not allowed. And if the NBFC is part of the co-lending, then they are required to do their independent KYC valuation. And they cannot rely only on the KYC provided by the business partner. The respective NBFCs must do their independent KYC valuation. So this was a weak internal control which we have seen in certain cases. So we thought the whole idea from my side today is to talk more on the practical sense as to what have been the practical issues which we have noted. So those practical issues will help us to focus more rather than more on the theory side. So that is what I will try to focus today. So this was one thing which we believe on the KYC was a big control in some of the companies where they were involved into the co-lending business. Right? While doing this KYC, the NBFC should also have all the relevant details, and they should create the unique customer identification code, which they do for their own customers. Similarly, even in the co-lending business, they must do that. Right? There could be various other practical issues which we see in various NBFC or HFC audits, which we can discuss. Like one thing which we have seen is that the due dates, which is there as per agreements, as well as what they're informing to the customer is not matching. Suppose you have signed an agreement with the customer and it says that your due date is going to be 10th of every month, right? But in practical sense, you're asking the customers, no, your due date is 5th, you have to pay based on 5th. So customer is making payment as per 5th, but your agreement is as per 10th. So even if the payment is not coming from 5th to 10th, you are defining that as no default, because you are going here as per your loan agreement where it is mentioned as 10th. But when you're dealing with the customer separately, your communication, SMS and other things is going based on 5th. So that has been in cases in various cases, and that is why the regulator also came down and said 2 years back around that the due dates must be clearly defined and adhered, and there should be no separate due dates over there. So there some companies had this practice, few companies still have this practice. Wherever this practice is there, this in our view is not appropriate, and this is a challenge, and the audit, as an auditor, we must look upon that. Second thing we have seen in various NBFC audits is with respect to the long pending pre-EMI cases they're being called basically. So many cases, like suppose they have sanctioned 10 lakh of rupees, they disburse 8 lakh. So the EMI will not start, only the pre-EMI interest will keep on coming. And only when the balance amount of 2 lakh will be disbursed, they will treat it as fully disbursed, and then only the EMI will start. But till the time it is fully disbursed, they treat it as pre-EMI cases, and they recover only interest and treat it as a going fine, which again is problematic cases. Beyond a particular period, it should not continue as a pre-EMI, and there has to be a clear board-approved policy which should define for how long any NBFC can go, that company can go with pre-EMI. After that, even if that amount is not disbursed fully, the EMI should start, which will include the principal as well. Whereas in pre-EMI cases, it is only the interest amount which is getting paid. So that again is a challenge in some of the NBFC, which should be looked upon. Another issue which we have seen in audit of various NBFCs is with respect to the valuation reports, property valuations, right? So this has also been an issue, and many places the valuations of the properties were not happening or are not happening as per the RBI expectations. RBI says very clearly that there has to be a board-approved policy for valuation of properties, including collaterals, and that board-approved policy should define the entire methodology and frequency for respective type of assets. In fact, it says the guideline itself says that for NPA cases, that is substandard cases, the frequency is annually, that every year you must do the evaluation. But for standard cases, the regulations do not define as to how the valuation has to be. But it definitely mentions that if there has to be a valuation, how frequent, that is to be defined by the board of directors. So what is the board-driven policy in that? If the board has not defined and not given a frequency, then that is an issue, that is a challenge. Because the expectation of the regulator is that all the assets has to be valued at some point of time. Frequency is to be something to be decided by both based on the nature and maybe based on the size of the loan which has been given. So that can be seen, but there has to be a valuation to be there. So that is another aspect which we can see. And again, the valuation can be done either by the outside valuers or even by the internal technical valuers. Only thing, again, the regulation says is that if it is done by the internal technical valuer, then the qualification of those people should be similar to those which are prescribed under the company's registered valuer and valuers and valuation rules. So it should be those people should have the same qualification which are doing this valuation. So that's the only additional need in that regard. Otherwise, the internal people can also do the valuation. And the repurchased assets should also be covered in the valuation activity. It should not be left out. If there is any repurchased assets, there has to be a clear valuation for that also. So valuation is one important factor which we must see that how this is happening while doing audit of any NBFCs. Another issue or challenge which we have noted in any NBFC and NBFC auditors, multiple exposure on the same property. So if there is one property, say, and a borrower has taken loan X, now those loans can keep on reducing based on the repayments. And many times the borrower come to borrow additional money on the same property, right? And the NBFCs allow that, because if the value of the property is say 100 and they have borrowed only 20, and they come back again and say, I need another 15, and this is the property which the same property on which I want to borrow more money. NBFCs allow, the norms generally allow, they have the policies around it. But the problem which comes in such cases is that when you're giving or mentioning the property of value of that property for respective loan, which value you are mentioning. So suppose you have two loans, one loan of 15 lakh, another loan of 10 lakh. And in both cases, you are mentioning value of property is the same property of 100. Then when you have the overall computation, property is one, but the value is coming twice. And it is not getting bifurcated, that value is not getting bifurcated between the loans. So that challenge or that issue has been there with multiple NBFCs, whereas the value has to be bifurcated and to be shown separately on the respective exposures, because it can have impact on LTV, what loan to value ratio could be there. It can have impact on their capital adequacy ratio. So this can have various impacts. So it is important from auditor's perspective to see to it that the value of the property on which the loans are given, if there are more than multiple loans are given on the same property, then the value is properly bifurcated. And if it is the same is not automated and it is being done manually, then we have to spend another additional time to check that those manual working and the allocation done is proper. So that is one thing which we should take care. Another important aspect is with regard to the, especially for HFC, this comes, housing finance companies, where we give where they give the loan for purchase of plots or the construction of plots or self-construction, right? So these cases, the guideline allows that their construction must be completed fully within 3 years of first disbursement. So if I am disbursing the money today, within 3 years, the construction has to be completed. If it is not done, then it cannot be treated as a housing loan, right? So because in HFCs, there are two different aspects. One is housing loan, second is non-housing loan, because it can be HFC only if they are complying with the norms of minimum sanctions towards housing loan. But if it is in this case, it is housing loan, but if the construction is not done within 3 years, then it has to be treated as a non-housing loan. And even the provisioning requirement is different in such cases. So this needs to be taken care properly and to be seen more clearly in the audit. Another thing which we have noticed and which we feel to be focused upon is with respect to the processing fees and insurance amount. Some of the NBFCs have the policy wherein they fund even the processing fee or insurance amount which they have to recover from the borrower. So that is also getting funded, right? So it's not that it cannot be, but then you have to see whether the overall LTV ratio, the loan to value ratio, is taken care of while we are funding these amounts on processing fees and insurance amount also or not. Second, in case if it is done by HFC, in such case, it should not be treated as a housing loan. It should be a non-housing loan and it should be configured accordingly in the system, right? And the provisioning will also go differently as compared to the other loan which is given to the same party. So this classification and this non-compliance with respect to the funding of processing fees and insurance will have to be taken care of. Friends, another critical area which we see in an audit of any NBFC, again, and especially for housing finance companies, is with respect to the direct assignment cases, right? So what they do, so once they have funded to a borrower, they sell some of those loans, or in technical words, they assign some of those loans to other players into the financing industry. So suppose they have sold those loans. So why it is called as a DA direct assignment is because they do not sell it fully. They sell a percentage. So say 90% of the minimum has to be sold and 10% minimum has to be retained and up to 90% can be sold. So say they have done this selling, which is called as a direct assignment. So in such cases, if it is a real sale, like 90% is sold and the risk and reward is transferred and it is not with HFC, in such cases, the Ind AS allows that the profit on the same, which is going to accrue in future on these loans, you can recognize that now based on the present value, because you have done a true sell. And the customer is going to pay for, say, another 3 years, 4 years, 5 years, 10 years. So they will continue to pay, but you have sold it. Your risk and reward is over. So whatever you are going to earn in the coming 5-7 years, the present value of the same you can recognize now as your income. So that's an important aspect which is there in various NBFCs, wherein they recognize the upfront income by way of sale of these assets, which is called as direct assignment. Now, from the accounting perspective, there are 2-3 very critical aspects which has to be taken care of. Like I tell you, suppose the loan which you have transferred or assigned is actually the contractual period left is say for 10 years. So it means for up to 10 years, you may get that interest and you will get that benefit of, because say your interest rate with your borrower is 16%, and when you have assigned say at the rate of 12%, it means the differential 4% will come to the NBFC, and the discounted value of the same for the remaining period you can account now as the income. So what should be the life for which you should consider? If the contractual period is 10 years, can you actually recognize the income for the entire 10 years? Ind AS says no, you cannot do that. You have to actually estimate what will be the expected life, what will be the expected average life of those assets which have been sold. So if the average life is, the contractual life is 10 years and average life is expected 5 years or 6 years, you can only consider for those 5-6 years and accordingly recognize those incomes now. So that aspect is something where there is a lot of subjectivity involved and a lot of impact is involved, and hence that is a focus area in the audit of any NBFC. Apart from life, there is another aspect which is important here is the discounting rate. Like while recognizing, what will be the discounting rate at which you are going to recognize it, whether it is going to be your weighted average borrowing rate or it is going to be the underlying pool rate or counterparty rate of return, what rate you are going to use basically. So it should be generally based on the risk of the pool which you are selling. That should be the discounting rate which you should generally consider, rather than the overall borrowing rate of the lender, because it is not your overall borrowing rate. It is the risk rate of that pool which you are selling is more appropriate, in my view, to be considered rather than the overall average borrowing rate. So these are the 2 critical aspects in the audit of any DA cases which should be taken care of. Friends, some of the basic funders while doing the audit of any NBFC, one important thing, as I said, now for listed NBFCs, it has to be done as per Ind AS aspect, right? So Ind AS requires the amortization of the income and expenses with respect to various items which is there with respect to the loan book and other aspect. So if you're doing sales in sanctioning of any loan, you are going to have certain income and expenses relating to that loan. So some of them are such which are actually directly linked with the sanctioning or the disbursement of the loan. So the income and expenses also relating to that loan which you are giving should be recognized over the expected period of that loan rather than being done today. So that is what is expected, and that loan again period should again not be based on the contractual period, but based on the average period, similar like DA concept which I have talked about. 1 second. Right. So I was saying this period again should be based on the average folio of the cases rather than the contractual life. And industry average, at least like for housing finance companies, for housing loan and non-housing loan, is around 6 to 7 years. But it will differ from product to product. If you're doing say, consumer loan, that period is very less. If you're doing a microfinance loan, the period is totally different as compared to the LAP or other products. So depending upon the specific products, what is the contractual life and what is the expected life based on the past behavior has to be seen, and accordingly, the incomes and expenses have to be amortized relating to those loan assets. Key items which can be done, like for income, generally it is the processing fees, because it is directly related to your loan. If you're not giving the loan, you're not going to get the processing fees. It is directly relating to that. So this income on the processing fees should not be recognized upfront, but over the average life folio. Similarly, expenses which are directly attributable to the loans, like DSA commission or legal fees or technical fees or sales incentive to employees, those are directly linked. So you can't put the entire salary of the staff because salary will have to be paid. So that's not linked to the sanction disbursement, but you are paying any incentive that, okay, if you disburse this, you will get this incentive. So if it is directly linked to the disbursement or to sanction, then yes, those type of expenses can be considered to be related to the same, and it can be amortized over the period or the average life of the folio which is being there. One important thing which again we have seen is important and getting missed is for foreclosed loans. So you have done the averaging, but there will be some cases which will keep on getting foreclosed every year. So for foreclosed cases, generally, whatever was the amortized income and expenditure should get reversed, because the loan itself is foreclosed, so there is no point of carrying that income or expenses for future period. It should be closed in that year itself. And the company's accounting system should be such that it takes care of that type of reversals and that type of accounting, because it should be captured on case-to-case basis rather than just passing an entry on overall basis. So this is amortization of income and expenses, a very important and critical part which should be taken care of. There are various other things which we have seen with respect to audit of NBFCs. Like one important aspect with respect to the loan is how the custody of original security documents is happening. We have seen cases when you check that what are the legal cases going on or what are the customer complaints which are happening. One of the highlight point was that the company was not able to refund the original security document after the loan was repaid. And in such cases, the courts have come very heavily on NBFCs, and they have even been asked to reimburse the entire amount of the security, because if the original security document is not there, it can create into a lot of problem to the borrower. So that is one aspect which should be seen in more detail. Second analysis is on the fraud cases. The company will have the mechanism, the board-driven policy, but whatever fraud cases are coming, whether the company is actually going through the root cause analysis of that, are they trying to find what were the reasons because of which these frauds were happening, and what corrective action the company has taken on those cases, or to plug those loopholes, is something which as an auditor we must look upon. Another important aspect, like COVID-related restructuring happened earlier. What is happening now is a reversal of those, because many cases are actually being repaid or repayment is happening, and accordingly, those additional provisioning which has been done is getting reversed. The key thing only to be focused on that is that the reversal can happen as per RBI guideline only and only when we have a recovery of minimum 20% of the agreed amount has already been recovered. Then only you can reverse 5% of the provisions done, and a further 10% recovered, then you can reverse the other 5%. So that is something which, again, I believe is getting missed out at various places, and we need to focus on that. Another critical area in the audit of any NBFC is cash collection, right? So we are in a digital age where everybody is focusing to see how can we have everything digitized, and even the cash money is expected to come in a digital manner. Cash collection has its own issues, own problems, own challenges, and accordingly, every NBFC try to minimize it. However, it is not totally reduced. There are still a lot of cash collection, especially at far-paced locations. So controls on those cash collections, whether the company people who are going and collecting those cases are only authorized people, they are actually issuing the receipts to the customers then and there, they are depositing those cash amount in the bank as per the policy of the NBFC on the same day or next day or not. And what are the overall controls of the same is something very critical to understand from control perspective as well as asset classification and provisioning perspective, right? So if somebody says that I have collected cash and they have done the accounting in the books of account and hence the default is not there, but the cash is actually not deposited in that or deposited after 4 days, 5 days, 10 days, then how do you really know that the money was actually collected on that day and hence this was not an NPA case or this was not a default case? So the whole control on the same is important to be seen. Another thing on the cash is cash collection beyond 2 lakh for any party at one point of time. That is not allowed as per law, so that should not be there. Friends, one more issue which is being seen is on the penal and additional interest. So the NBFCs levy penal interest or additional interest for various defaults and other aspects. But many cases, they do not do the accounting of the same. And only as and when the money is received, they are doing the accounting. So the whole control on that many times is not appropriate. And a lot of time, there is a lot of revenue leakage also happening in that. So we need to, as an auditor, see and focus whether all the penal and additional interest, which is supposed to be levied, is either levied, or if not levied, then whether it is formally waived by any appropriate authority or not, is something which is important. And again, overall on the accounting side of the same. End use of funds is another important aspect, friends, which is always focused upon in any NBFC audit or any bank audit. So here again, the end use of funds is important, whether how the companies are tracking, NBFCs are tracking, that the borrower who taking the money is actually utilizing the money for the purpose for which the same was taken. So that becomes a critical aspect. Few more thoughts from my side, like asset held for sale. In any NBFCs nowadays, what happened that the some asset which you have take the possession back, in that case, it is not being shown as a loan. So even if there is a default and there's an NPA case, once you take possession, it will take out from the loan and the classification, and then it will be shown as an asset held for sale. So now, since it was earlier a loan and now asset held for sale, the accounting for the sale, accounting of the same becomes very important. Because if it would have been a loan, maybe after some point it would have been provided fully. Whereas you have taken back the asset, now it is asset held for sale. Now it is not getting provided as per the IRAC norms or as per ECL norm. So here again, two important aspects. One, whether the NBFC is taking proper valuation of those assets. Are that being taken care of? Every year that valuation should happen to find out that what is the asset value which is backed for those items, and that based on the value only I can consider. Second, whether my actual realization is as per those valuations or not. If there is a major gap in that, then again, that is a matter of concern and additional provisioning will be required based on the same. So this again is important aspect in audit of any NBFC. Friends, one more thing which we have seen is very critical, that since there was a regime in which the interest rate was increasing, so based on the increase in interest rate, most of them were floating interest rate. So the rate of interest for the borrower customer has also increased, right? But since the rate of interest has increased, in many cases, the EMI has not increased and the period has been increased by the NBFCs. Fine, you have increased the period, but while increasing it, there are certain critical things which should not be ignored. Like you cannot have a situation where the customer will not be in a position to pay beyond a period, or he will cross the age. Like suppose you are having a salaried customer, he will work till 65 years. You have accordingly given him loan. Now the interest rate is increasing. You have increased the EMI period such. Now that he will have to pay till 80. How will he pay after 65 years? That's a big question mark. And then naturally thereafter, the chances of default will be significantly high. So whenever these changes are happening, whenever these revisions are happening, it should again, number one, driven by a board policy. Policy should be very clear that there should be no breach of maximum age requirement, or the repayment capacity must be seen. And then only it should be allowed, the period should be allowed to increase only up to that period and not beyond that. Right? So that is another important aspect which should be taken care of. Many times the most important aspect, another is ECL. This is the last thing which I would like to discuss today before I close. So ECL is something which is the heart of any NBFC audit, because the profitability to a large extent will depend how much defaults are there and how much ECL is coming. So when we were doing the audit earlier, when it was not as per Ind AS, and it was as per IRAC norms, in such cases, the provisioning were happening on the criteria given by the regulators, that if it is standard, such type of assets, so much of the provisioning, substandard, so much, doubtful, so much. Here, it is basically, in ECL, basically under Ind AS, it is depending upon how much impairment is actually happening at present, and what are the forward-looking information based on which you can have a reasonable estimate of the loss happening. So the entire ECL is based on what is the current condition and what is the reasonable and supportable forward-looking information based on which you can find out what could be my loss. So ECL is nothing but actually a cash flow which is due to the entity, and what is the present value of the cash flow which the entity expects to receive. So the difference of the same is actually the loss, right? So in this case, ECL working needs to be seen from company to company based on the past records and past detail of the losses which has been in the company, and some of the forward-looking information as to how those things can impact me in future. In case of companies which do not have that history, like suppose the companies which are there for more than 5 years, generally, that's a general norm which is being considered. In such cases, you do have the history of 4, 5 years, 6 years, 7 years, to really make some evaluation and see that what has been the trend and what could be the trend. But if it is a new company, it started 6 months back, 1 year back, 2 years back, in such cases, the standard allows that rather than taking our own history, we can take something which is there in the industry. So my similar type of industry, what are the losses there and what is the provisioning there, you can take that. CRISIL also comes and publishes that data many times. So you can use those data for the purposes, for your own provisioning purposes. But if you have your own history, you take your own history to find out as to what the provisioning is required. Now, second thing, in IGAP, what we say that it is standard and non-performing, basically. Performing and non-performing, actually. And then in performing, non-performing, you will have substandard, doubtful, and loss assets. In this case, the Ind AS requires that our classification should be on 3 stages. Stage 1, 2, and 3, right? Stage 1 is 1 to 30 days default. Stage 2 is 31 to 90 days default. And stage 3 is more than 90 days. So all NPAs in that terms is actually stage 3. Whereas stage 2 is something which is default beyond 30 days, but up to 90 days. So it is not an NPA, but it is a stage 2, right? So the Ind AS norms are based on stage 1, stage 2, and stage 3. Now, stage 1 is basically a performing case. Even if there is a default, it is up to 30 days only and not beyond that. The credit quality is not deteriorated significantly since its initial recognition. It is almost at the same level. Whereas in stage 2, it is considered that it has deteriorated significantly, right? 31 to 90 days is basically one criteria. There could be some other criteria based on which you can call the asset as a stage 2. Like suppose you have done any renegotiation of the terms, or you find that the security which was there has been deteriorated, though it is not in default. So there could be various other reasons to say that it has deteriorated significantly since the initial recognition. So if it has deteriorated significantly, then it becomes stage 2. And it becomes stage 3 when there is a clear evidence of impairment, which in this case is generally, if it is more than 90 days, then it is considered to be a clear case where you have an evidence of impairment, and hence it is stage 3. So these are the 3 stages on which it is defined. And now, when you find out the provisioning which is required on the same, for if it is stage 1, you can take 12 months ECL, whereas in stage 2 and stage 3, you take lifetime ECL for calculating the same. And the whole mechanism will work on that basis. And then you must be aware generally that, yes, we have to find out what is the exposure at default, what is my PD ratio, what is my LGD ratio. And then, as I said, based on your past trend, based on your past data, you find out what is my probability of default, what is my loss given default ratio, and what is my exposure at default. And accordingly, it gets calculated for the respective stages and gets provided accordingly. In case the provision which is worked out as per ECL is lower than what is required as per IRAC norms, in such cases, the RBI circular requires that we create a reserve if it is such the case. Whereas if the provisioning required as per ECL is higher, then that's fine. You create the additional provisioning and total provisioning as per ECL. But if the provisioning required as per ECL is lower and the provisioning required as per IRAC norms is higher, in such case, the difference needs to be created as a reserve in your books of account. Few other things in this difference between the IRAC norms and this ECL provisioning norms is that in case of IRAC norms, your NPA provision was being shown separately in the balance sheet, whereas in case of India's, it is reduced from the loans and being shown. One other important aspect that in case of IRAC, we do not calculate on undrawn commitments, whereas in case of ECL, we have to calculate the ECL on undrawn commitments as well, right? And the while calculating the ECL, we can do the overall assessment if there is some homogeneous group, and if there is a larger cases, we can do on the individual basis also. And in case of homogeneous group, it can be done on overall basis, basically. So that's the key. I think my time, which was allotted to me, is almost over. I'll be happy to take any questions which will come at the end. Thank you, friends.
Thanks, Vikasji, for sharing their view on vital issue related to NBFC audit. Now, we request today's second eminent speaker, C. Chinnaswamy Ganeshanji, to start their deliberation on today's topic. Thank you.
I must thank the Auditing and Standard Board for giving this excellent opportunity of interacting, along with eminent speaker Vikas and also the two great moderators of the session on this important topic of key consideration and the audit of NBFCs. I must thank Mr. Vikas for setting the tone for the entire discussion and also covering the overall areas, especially the key area of advances relating to the operations of an NBFC, which is actually on the asset side. And to some extent, what is the revenue recognition relating to the same also has been touched upon in great length. And he also touched upon the expected credit loss, which is required to be considered in accordance with India's 109. So what I am planning to do in the entire discussion which we are going to have today is the areas relating to appointment of auditors, because in a very recent case of an NBFC, you might have seen that the branch auditors have been appointed and they have accepted the audit, and the NFRA has come out very heavily on them, saying that their appointment is not valid in accordance with the requirements of the Companies Act and other provisions, etc. And accordingly, what is the norms relating to statutory central audit of the appointment process and etc. we'll see. And highly regulated industry is this, because RBI as a regulator is closely watching each and every aspect of the performance of an NBFC. as well said by because G, relating to various circulars and the master circulars, etc. So how the expectations or understanding of the laws and regulations will have an impact on the audit procedure which we will be performing. And then what are all the key areas of audit focus other than advances, other than the areas covered by Vikas? Maybe in my slides, I may be having touching upon some of the items which where it is covered by Vikas Ji, I will actually skip on those areas. And what are all the key issues which we will be having, or maybe how best we can actually do the audit to de-risk the acceptable level of audit related issues. So the problem is when we give an audit opinion, the first question which is coming in is whether it has an audit risk involved. Naturally, every audit has an audit risk. How we are bringing the audit risk to the acceptable low level and what could be the possible way of doing it. And the other area where we will be concentrating a little bit is data analytics, mainly because majority of the operations of an NBFC is system driven. And to that extent, what are all the involvement of an IT specialist in the audit of an NBFC? And because it's a voluminous data which we will be considering for the purpose of audit, a simple sampling technique may not be helpful. So some sort of data analytics tools should be employed. We will also look into that. That's what I wanted to cover on an overall basis. I'm happy to add any other items which we believe that it may be required for our consideration. So one first start point which I wanted to talk about is in every audit, understanding the client's business, understanding the laws and regulations relating to the particular industry is very important. And especially in an audit of NBFC, understanding the laws and regulations is critical because NBFCs, like banks, is principally regulated by Reserve Bank of India. And of course, if it is a housing finance bank, then to some extent you also get covered by NABARD and National Housing Bank regulations as well. So accordingly, what the regulator has given as a guidance with respect to prudential norms, capital adequacy norms, rules, regulations, etc., has to be looked into by the auditor with very, very serious consideration for the purposes of determining what could be the key risk which he has to address. Because SA 315 is talking about assessing the key risk in an audit, and then SA 330, which talks about how an auditor will respond to assessed risk of material misstatement. So accordingly, understanding laws and regulations is a critical assessment of key risk. And of course, when we were talking about certain norms, the fundamental thing which we have to look at is whether an NBFC is having the minimum net owned funds criteria. Sometimes what happens is because of accumulated losses and because the NBFC might have given loans to related parties, the computation of minimum net owned funds in accordance with the circular given by RBI, it has to be done on a regular basis. Every audit, or maybe if it is a listed NBFC, naturally you have to do a limited review. At every quarterly limited review also, you have to see whether the minimum net owned funds criteria has been met or not. Because the computation of net owned funds is given by means of a regulation. So accordingly, we have to look into that. I have seen cases where there are issues surrounding this. For example, in one of the cases which I have seen is that an NBFC has actually given a loan to a group company, has made an investment in a group company. One is an investment, which is a listed entity in which they have made an investment, and another is they have given a loan to a group company. That group company has underwent a NCLT process. CARP has come. So when the CARP has been commenced, the issue for the auditor is to see how the net owned funds and what is the implications arising out of the investments I have made in a company which is related, and the advances made, whether it is recoverable, how it will impact my net owned funds. The management is of the view, despite it has gone into NCLT, that particular investing company is having very huge land banks and immovable assets. Their normal stress value itself is higher than the total value of loans which is due to the various stakeholders like consortium of bankers. And accordingly, even though the investment made is an investment, given is an unsecured loan, they of the view that it is 100% recoverable. By going through the IRAC norms, automatically I will consider that as a substandard asset. But when this NBFC is under Ind AS, the substandard asset or my doubtful asset criteria and provision based on that level is not warranted, because what they are saying is I have enough amount of recoverability and accordingly it is not required. Now, coming into the expected credit loss required under Ind AS 109, as detailedly explained by Vikas G, when we are looking at the default, it was under default and goes into stage 3. But the last given default in this particular scenario, because there are 3 components involved, in the last given default in this scenario is I could recover 100% of this money based on the present conditions. And accordingly, the model which they have developed says that the provision required in this case will be not required, or maybe it is very minimal, like it is applicable to any other loans and advances. But the problem for the auditor is, can I take the view that whatever the company is talking about is fully acceptable to me, or it is dependent upon what is the future course of action? Whether the investing company goes for a liquidation or the investing company is going to have a resolution plan. At this point in time, it is contingent upon future events, and I could not consider whether it will happen as such. And accordingly, what has happened was, in the assessment of the management, net owned funds are available. In the assessment of the auditors, if these 2 adjustments has to be done, the net owned funds are not, criteria is not met. Accordingly, the best way of dealing this scenario is a modified opinion, considering that if these provisions are made, naturally the net owned funds will not be met. If the net owned funds is not met, the company cannot function as an NBFC. So automatically the going concern issue, material uncertainty relating to going concern, will also kick in. So you have to always look at on a holistic basis when you are doing an audit, considering the situations, various laws and regulations which are considering the operations of this. The second important point is a circular which has been issued by RBI by means of a regulation, how the auditors of, or maybe I can say statutory central auditors, SCAs, are to be appointed with respect to banks, urban cooperative banks, and of course the NBFC. They have covered all the 3. Because she has also touched upon about the threshold limit of 1,000 crores of asset size as a criteria, right? Now, what is the various considerations which are required? Because the regulators are also looking at FRRB or the Quality Review Board or NFRA. When they are reviewing the work performed, they also look at whether the SQC, standards on quality control, across the entity, across the audit firm, across the engagement is fully covered or not. When they are looking at that, the fundamental principle which they are saying is, as according to SA 200, whether the audit appointment itself is properly done or not. So quickly we go through that. The first point which we are looking at is the RBI guidelines has started from financial year 21-22. Before that, it is left to the management to take a call and the panel is actually deciding. Now, what they are saying is that it is applicable to all non-banking finance companies and housing finance companies which are having an asset size of 1,000 crore or more. For them, the eligibility criteria for the audit firms to become statutory central auditors have been given in Annexure A. In the Annexure A, they have talked about how many full-time audit partners should be there. Out of that, how many should be fellow members, and how many should be information systems auditors, and how many should be professional staff. All these criteria has been very clearly spelled out, and it is also talking about the independence and other requirements of the auditors to be followed. And interestingly, it says the maximum period for which an audit firm can be appointed is for a period of 3 years. Two problems may come before the commencement of this particular thing. If an audit firm is already completed 1 year of audit, what they say is the only balance 2 years they can continue to be the auditor. That means financial year 22-23 and financial year 23-24. They cannot go beyond that. So the prior period of service as an auditor should also be taken into consideration, and that should be reduced from the 3 years appointment in respect of existing auditors before commencement of this particular regulation. So it is not allowing on a prospective basis, but it takes the retrospective period of the auditorship as well. And interestingly, when we were talking about a cool-off period for audit of companies as one term of 5 years, interestingly for NBFCs, the cool-off period is 6 years on a continuous basis. That means 2 terms of 3 years, you cannot get appointed as the auditor. And during the cool-off period or before the cool-off period, before your appointment, what are all the restrictions is another interesting point which comes in. So if the existing auditors who have already been there before the regulation comes in, say for example, I'm the auditor right from 2021 onwards. Then in 23-24, when I'm assessing whether I'm eligible to do the audit or not for the current period, every year the eligibility should be in accordance with this regulation. If I am not meeting the criteria, automatically I will be vacating the office from this particular NBFC, and another auditor should be appointed in my place. So it is not a question of I am completing just because I have already started my 3 years period. Every year the criteria should be met. That is an interesting point. And accordingly, as an auditor, when you are continuing the auditorship of a particular NBFC, you have to continue to evaluate whether you are meeting the criteria fixed by the RBI regulation. And the interesting factor, it is also saying that some of the NBFC can have just a single auditor, and other NBFC should have joint auditors. And the number of joint auditors, they have also mentioned what should be the minimum number of statutory central auditors as a joint auditor. If the entity NBFC is having an asset size of 15,000 crore or more, there should be minimum 2 joint statutory central auditors. If you have been appointed as a only single statutory central auditor and you are accepting the appointment, you are not in compliance with the regulations. You should inform them it should be minimum 2. And the maximum, and in case of other cases that is less than 15,000 crore, then you can have 1 single statutory central auditor. So asset size is very important. What is asset size? Is nothing but your loan book, right? That is what you are supposed to look at. Interestingly, if the entity wanted to appoint more number of joint auditors, there is a maximum number of joint auditors restriction is also fixed by the regulation, which says that if the asset, it starts with maximum 4 and goes up to 12, depending upon the size of the asset. For example, asset size is 5 lakh, you can have maximum of 4. If it is 20 lakh crore, you can have maximum of 12. You cannot simply multiply by that 15,000 crores into 2 for number of the statutory central auditors you wanted to appoint. It should be very clearly based on the threshold limit which has been fixed by the regulation. And they also made it very clear the maximum number of audits which an audit firm can accept. For example, it says for commercial banks, 8 urban cooperative banks. Let us leave it as such. And 8 NBFCs is a maximum thing which we can talk about. One fundamental question which comes in is that this regulations is applicable only where the NBFC is having an asset size of 1,000 crore or more. So if the asset size is less than 1,000 crore, can I remove the number of NBFCs from calculating my audit? Interestingly, there is a conflict in the regulation itself where it was silent in one area. In another area, they are saying asset size exemption is not available. That means if you are having an NBFC having only, say, for example, 2 crore net worth or asset size, another is 200 crore net worth or maybe 2,000 crore net worth, each are considered as the same thing. That is the reason why every statutory central auditor, before accepting the audit of an NBFC, they are trying to assess what is the biggest advantage for me in accepting this particular audit. If it's a smaller audit, why should I accept this audit? Is what is the way in which they look into that assessment. And interestingly, suppose if you have done any non-audit work with respect to the same NBFC, you cannot be appointed as a statutory central auditor for 1 year period. So before your appointment for the previous 1 year, you should not have been doing any non-audit services. That is interesting. And the question which comes is whether it should be to the entity or the group of the entire entity. For example, it's an umbrella of several companies. One of the entity is the NBFC, which I am doing an audit. There are other companies are also in the group. Whether this restriction of non-audit work is extended to the other entities also, RBI has come out with a very clear instruction where they say if the other entities are regulated by RBI, then they should also be considered for non-audit work, whether the auditor has or the audit firm has done. If they have done within the previous 1 year, they are not eligible for getting appointment. On the other side, regulated by RBI, they are normal companies. In those scenarios, RBI says that it doesn't impact the auditor's independence. You can do the non-audit work and you can also do the statutory central audit. You can accept. But the thing which they are saying is whether it has an implication on the auditor's independence should be evaluated by the audit committee and the board of directors of the entity. That is what they are making it very clear that the board and the audit committee has a very clear requirement. And there could be another possibility. I am the auditor for an industrial group or various entities. They are having large exposure to the NBFC. In that case, can I accept the statutory central audit of this particular NBFC? Again, they are saying that there is no such restriction because you are doing an independent auditor of the other entity and you are doing an independent auditor of the NBFC. Just because your other audit client is having a heavy exposure into this particular NBFC, that doesn't mean that you have an independence issue. But at the same time, they are saying that make the disclosure, let the board and audit committee evaluate the conflict of interest, whether anything is coming in. If there is a conflict of interest, they are saying avoid that conflict of interest and don't accept the appointment. And sometimes this is an area where independent directors are being appointed by NBFCs. And suppose if a partner of the firm is a director in an NBFC, then the firm is ineligible to accept this statutory central audit. Similar to that, what we have seen in respect of non-audit work, if there are group companies which are regulated by RBI, and if a partner of the firm is a director in that regulated enterprise, then also the firm cannot accept the audit of the NBFC. Non-regulated group enterprises, similar assessment, whether it has any conflict of interest, has to be made by the board, and the auditor should also make a proper disclosure. Okay, that is on this audit. And what I have seen in the way in which the audit moves from the audit of what we have seen earlier, whether it's a bank audit or NBFC audit, or even for the case of a normal company audit, we are moving from a traditional approach to a tailored approach. So previously we used to look at transaction-based audit. Whatever Vikasji has discussed, whatever I am discussing, if you look at, we are not looking at transaction-based audit approach. We are looking at what could be the possible business risk which will result in a material misstatement. Whether the auditor has looked at those business risk-based approach in his entire audit plan, audit strategy, audit procedure, nature, timing, and extent of the audit procedure is what we look at. Previously, we go for a periodic audit plan based approach. Now it is a real-time business cycle-based approach. Every time something happens, immediately another aspect comes in. You recollect that because he was mentioning about a fraud risk issue. For example, in one territory, one fraud which has been observed, let us see based on a KYC issue. A wrong KYC, because whenever you give a credit or loan, you should always look at a CIBIL score. And you should also look at, NBFCs are mentioned that the total EMI which has to be paid cannot go beyond 50% of the family's income. So this two assessment is critical. When you give any loan without considering this, it will be considered as a violation of the RBI norms. So accordingly, in the KYC norms, if somebody is finding that the CIBIL score of a particular borrower or applicant is not correct, and they are substituting with some other evidence, like say for example, a voter ID information or another information, only the number has been affixed and based on which the assessment of credit has been given. Because if I look at that particular other number, CIBIL score is particularly available, or the voter ID, CIBIL score is available. But when I'm looking into the actual applicant's case, he may not be eligible for any loan. So if that we have identified in one of the branch, let us assume, then we have to look into or deep dive into that particular scenario and see what is the root cause for this. Is it only a KYC norm as a random basis there is a problem, or it is a systematic failure of the KYC norms being considered, and because of that the credit has been advanced? If that is the case, I'm not stopping at the credit alone, and I now look at the integrity of the management, integrity of the staff, integrity of the particular circle employees, and try to find out whether this fraud is limited only to advances or it is also to be extended to other areas. Unless I do a real-time and business cycle-based approach, this will never happen. So the auditor should be very alert and look at what is happening. And of course, how the business performs is another important point. There is a concept called portfolio at risk, or PAR. Continuously, PAR is being reviewed in every audit committee, in every board, in every MIS information. If PAR plus 1 or PAR plus 30, the moment it goes up to PAR plus 30, I have an issue that there is a significant increase in credit risk, right? So accordingly, how the business performance is being monitored and what are all the remedial action which is being put in place is also an important approach which the auditor should look at. And of course, as I have mentioned earlier, data analytics is very, very important tool because the voluminous data is actually looked into. In simple terms, I go with the business and key business drivers. What is the top-down risk-based approach which I have to evaluate? for the purposes of evaluation of my risk of material misstatement. I go for the next level of control testing and how it impacts on the financial reporting. Internal control over financial reporting report will also be given. So naturally, you will be doing the test of controls. Based on the comfort which you have taken on the test of controls, you will look at the other audit procedures, substantive audit procedure, confirmation of balances, review of transactions, etc., etc. You will do that. Apart from that, there could be certain key focus areas in every balance sheet line item or every P&L line item, which you have to look at how the management makes an estimate. Estimate could be with respect to expected credit loss. Estimate could be on valuation of securities. Estimate could be value of investments. Estimates could be employee cost. Estimate could be even the economic useful life of an asset. So key estimate, list out the management estimate, whether there is any bias which you believe that the management is having on that should also be tested in accordance with the standards on auditing. And in some cases, I believe that there is an heightened risk of material misstatement of maybe litigations or maybe taxes, maybe information technology fails. And accordingly, expert in those areas should also be involved as part of the audit. That's the reason why they are saying whether systems information auditor, DISA or CISA qualified is part of the audit firm is also specifically asked, right? And if your team is not enough, you should also think about engaging them. In fact, I have seen that in majority of the NBFCs, the better way of approach is using the IT specialist to do the initial assessment of the IT controls, IT general controls, and of course, application controls. Based on the gaps which they have identified, what should be my audit procedure to address the gaps to mitigate the possible risk of material misstatement arising because of that IT general controls and IT application controls gaps. Very, very important, because majority of the items are driven by systems. And again, whatever interim findings which you are talking about and based on which you have to regularly update your audit strategy. So every limited review is going to give you an input of how you have to move forward for the next quarter, how you have to plan your detailed audit at the end of the year, because limited review and audit is different approach. So how some of the findings which you have taken during the quarter has to be considered in detail for the purposes of getting the audit comfort before you issue an audit opinion. So issuing an audit opinion, issuing management letter on improvement areas, and debriefing the audit process with the board or the audit committee is an important consideration under the standards on auditing. In fact, in many of the NFRA findings, I have seen that they have mentioned that the auditor has not discussed with those charged with governance the significant accounting and auditing matters arising out of it. They have not discussed how they have concluded on that. They have not discussed what is the assessment of fraud risk by the management and those charged with governance. These are all the areas where they have identified there is a quality control gaps in respect of audit procedure. So it is very important to look at that also as tailored audit procedure. As I have mentioned earlier, data analytics is very, very important because you can extract the data in total from the system of the client, and you can actually decipher, or I can actually say that I can disaggregate the data to my individual need to get the comfort on the areas where I consider susceptible fraud risk or areas I consider there could be a possible key risk and there could be a possible risk of material misstatement. How I am getting the comfort, I can do a lot of activities by means of my data analytics. In fact, data analytics can also be used for the purposes of compliance parameters like KYC, etc., can also be taken into consideration. So that's very interesting. In fact, what I have seen is if the entity, audit entity, is using the data analytics at length, they will be able to identify the exceptions upfront, and based on which the audit procedure can be planned to have a very or maybe extensive comfort on the areas of audit rather than just doing a sample work. Now I am looking at certain areas of key areas. The loans and the financial asset, I'm not going to look at because it's already dealt with by Vikas Ji. I move on to investments in group companies, investment in pass-through certificates, investment in non-convertible debentures, investment in debt funds, and of course, the moment you are having all these items, the accounting, because majority of the NBFCs which we are talking about, because it's an audit of listed companies, is the series, and out of which we are looking at NBFC. All the listed companies which are NBFCs in our discussion, they are supposed to follow Ind AS. The moment you are following Ind AS, the financial asset has to be classified into various categories as given in Ind AS 109. Read with, in case it is financial liability, you have to also look at whether it's a liability or it is an equity from the perspective of the entity, NBFC's entity. So the fair value assessment, the amortized cost accounting issues, because majority of the cases when you see the non-convertible debentures might be coming at a very low rate of interest. Market rate may be 10%, but you are getting it at 0.001% because one of the promoter might have given or the investor might have given this as an additional funding for the purposes of the business. And the exit route for the non-convertible debenture could be at a premium at a later point in time. So when this type of transactions are there, the amortized cost accounting should also be looked into very, very clearly in respect of investments made by NBFCs. And of course, when we are also talking about debt securities and other borrowings, there could be a possibility that NBFCs is not only looking at their own funds, because some of the NBFCs may be deposit taking NBFCs, some of them are non-deposit taking NBFC. For example, microfinance companies, MFIs are not deposit taking entities, and they are only going with their own fund rise or capital rise, and they will also look at what is the fund available in the market and try to work on the spread between what is my cost of borrowing and what is the cost of my lending, or what is the rate at which I will rent, what is the spread, whether that spread will be beneficial for me. That's the way in which they look at. And some of the structures in which these fundings may be coming in could be term loans from banks and other parties. And in that case, the effective interest rate method has to be applied for, because he has also touched upon transaction costs relating to that, not only in respect of advances I have given, in respect of loans I have taken also, I have to look into to arrive at what is the expected or effective interest rate which I have to do, not based on the contracted interest rate. And there could be a possibility of accounting implication arising out of convertible debentures or convertible preference shares, because there are a lot of confusion and maybe presumptions or preconceived notions, which I can say, with respect to the convertible debentures and convertible preference shares. The moment I'm saying it is convertible, I normally consider that it's an equity instrument. But if you are reading with Ind AS 32, Ind AS 32 requires the entity to assess whether the entity has an obligation to pay off this even at a particular contingent event. For example, in one of the scenarios which we have seen, they have said that in case it is not able to convert, there should be a buyback arrangement where the promoters have to brought in the money. Promoters in their individual capacity has to brought in the money, but not company does not have anything. But still, there is an interpretation which has been made by the accounting audit firm that it should be considered as a liability, and the liability should be accounted based on the amortized cost model. It cannot be part of your equity method. The moment I'm saying that it is not part of my equity and it is part of my liability, you have to also look at how that impacts your CARR or your CR, AR, and other ratios which are required to be complied with by the NBFCs with respect to the regulations given by RBI. Revenue from operations, because it is arising out of the advances. So Vikas ji has already considered that, including accounting for effective interest rate model. He has talked about the acquisition cost and processing fee income, how it should be considered for the purpose of determining the effective interest rate model. But on the other side, which I have seen, is employee benefits is a huge cost for any NBFC. Accordingly, we have to look at whether the NBFC is having only a normal employee benefits like salary, bonus, PF, ESI, gratuity, leave encashment, etc., or they are also having some special arrangement like employee stock option plan. If ESOP has been given, under Ind AS, ESOP has always been accounted on fair value model. You cannot go for an intrinsic model, which is permitted as per the guidance note under AS model. So when we are going under Ind AS 102, there could be a huge impact which will be coming to the P&L. I still remember that when we were advised one of the NBFC from transition from AS to Ind AS, the major impact which we have seen between AS to Ind AS is in respect of the employee stock option plan, which the entity has already given before the commencement of this. And there are outstanding or non-vested shares, employee stock options were non-vested, and to that extent, the fair value measurement has huge impact on the opening equity as well as every year's performance. Okay, that is an essential assessment the auditor should look at in respect of employee benefits. And of course, you always look at your gratuity, compensated absence, accrual of bonus, performance-based incentives, etc. What is the period for which it is arising out of it, but whether it should be recognized as a long-term employee benefit or your retirement benefits or your termination benefit, because the accounting under Ind AS 15 is Ind AS 19, sorry, Ind AS 19 is completely different. AS 15 and Ind AS 19. So it is completely different, and you have to look at that. The major issue we have seen when we were looking at the employee benefits like gratuity, compensated absence, etc., is that the audit firm has not validated two things. One, they have relied on the work performed by an expert, actuary. For that, there is a standards on auditing ISA 600, whether you have considered all the arrangements or all the aspects of that particular standard for the purposes of relying on this. One aspect. The second aspect which we have seen as missing is that the base data provided to the actuary is arising out of your accounting books and other records, which is subjected to your audit. Have you tested the base data provided for the completeness and correctness? If that is not there, the valuation made by the actuary could also be a problem. We have seen one single case where the base data provided to the actuary was matching with everything, and the actuary has given a valuation report in which the actuary has restricted the gratuity provision to the maximum limit provided under the Payment of Gratuity Act. This was an audit rotation, so previous auditor has already done that audit, and we have taken up the audit. And the normal audit procedure is when we are talking about employee benefits as being a key risk area and important area for an NBFC. What we have actually taken is that we have looked into that aspect as well to see what is the policy of the entity and whether the policy is matching with whatever is being accounted by means of external valuation. Interestingly, the team has identified that in the provision for gratuity, there are debits which are more than the threshold limit provided in Payment of Gratuity Act. When we have seen that debits, nothing but payments, right? But the payments has been debit. The next aspect which we have seen is it for a single party or for more than one employee? Wherever it is for a single employee, we went and discussed with the HR department, what is your policy? The HR department very clearly said that job security is one of the important aspects in our entity, and our employees are working for 30 years and 40 years, and they started their career and grown for higher levels also. With the pride, they were mentioning that. And we have asked a simple question, how you pay the gratuity. For every completed year of service, half a month's salary under the Payment of Gratuity Act. Then the next question came was, have you restricted to the maximum limit provided by Payment of Gratuity Act? He said, no such policy is there. Our policy is silent on that. So in that case, how the actuary has restricted that? When we ask this question, they have woken up and the re-evaluation of the actuarial valuation has been done. Friends, you will be surprised to see that the impact was around 40 crores on a cumulative basis. The question came was, if the entire 40 crore has to be accounted in the current year, it will impact the current year P&L. What we have suggested is, as per Ind AS 1, you consider the cumulative impact of the previous thing, read with your Ind AS 8 as an adjustment of an accounting error. You correct it in the previous period, in the opening retained earnings, recast your balance sheet, present period balance sheet, and also the related restatement of the previous year number, and what is important for the current year, you make the adjustment. But it's an embarrassing situation unless we have not even asked a simple question of what is your accounting policy, what is your employee policy, and whether your accounting is in accordance with the policy. And of course, the finance cost, interest on loans, interest on debentures automatically comes from your borrowings. And the next area which we have seen is the property, plant and equipment. And of course, in property, plant and equipment, what we have actually seen is that majority of the NBFCs are not having any major machinery, but they normally have a leasehold improvement because they will be functioning across many branches across the country. And to that extent, every branch will have an infrastructure. That may be a leasehold improvement. In most of the cases, they might have taken on lease. The moment I have a leasehold improvement, can I say my leasehold improvement will be equivalent to furniture and depreciate based on Schedule 2 of the Companies Act? What is the estimated useful life? Can I go with that rule? We have to be cautioned by another important standard under Ind AS 116 on leases. The moment I have a leasing arrangement, I have to always look at three aspects put together. One, whether I have a right of use asset or control over the asset. In other words, simple term is whether the lease period is having a lock-in period. If there is a lock-in period, I have a right to use asset. If there is a right to use asset, I recognize the lease asset or right of use asset, lease liability, and the payment of my monthly rent will be adjusted against the lease liability and the interest on lease liability, and depreciation on the right of use asset over the lease period. This accounting you are familiar with. But the problem is, if I conclude that my right of use asset is only 3 years and I have leasehold improvements which is depreciated over 5 years, my charge to P&L is not correct. Similarly, if I conclude that I do not have a right of use asset because all my leases are short term in nature, 11 months or less than 12 months, in that case, you don't have a control over the asset, and accordingly, you cannot depreciate. In one side, you can say everything is short-term leases, so I will debit all the lease rent into P&L. On the other side, you will say leasehold improvements, I will amortize over or depreciate over 3 years period or 5 years period. It may not be correct. Similarly, a rental deposit which you have given, which is not having an interest, should also be amortized in accordance with this similar scenario. So your depreciation on leasehold improvements, your right of use asset assessment, and your amortization or fair valuation of your rental deposit all should be looked into in a holistic arrangement. Normally, we will miss on this particular area. The compliance and taxation is very critical because when we were looking at the compliance, as we have started with saying that laws and regulations are critical because it's highly regulated by Reserve Bank of India. RBI's circulars, regulations, master circulars, prudential norms, everything has to be looked into in full. Any non-compliance, any reporting non-compliance also has to be looked into on a important basis, because nowadays I have seen one of the NBFC has been levied a penalty of 1.86 crore for some KYC related issue. Another NBFC has been levied a penalty of 96 lakhs. So these amounts may be material for the financial statement. So you have to look at non-compliance with the laws and regulations. And of course, you also have another requirement, NOCLAR, non-compliance with the laws and regulations require and disclosure, or the auditor should specifically report that with respect to NOCLAR requirement for listed companies. So that should also be looked into. Naturally, it being a company, Companies Act compliance should also be looked at, including related party transactions, which is normally an issue with respect to NBFCs. You have to look at that particular aspects. Direct and indirect taxes, several litigations we have seen in direct taxes, because the way in which you have calculated your computation, you have considered your provision, but the assessing officer is not considering that as an allowable provision. So he has a different view. You are considering that the provision is applicable because you are operating in a specified area, but the assessing officer says that it is not, the entity is not eligible for it. So every time the pending litigations, pending assessment has to be also looked into in detail. And of course, whenever we are talking about the taxes, we should also look at what is the implications arising out of our ICDS as well. The others, lease accounting, I have already mentioned. Direct assignment and securitization, Mr. Vikas has already discussed that. Deferred tax accounting, I have seen a lot of issues. The main reason which I have seen in deferred tax accounting is that under Ind AS 12, you are supposed to reconcile the effective tax rate with the normal tax rate applicable. In other words, your deferred tax and current tax put together should be equivalent to, say, for example, 25.168%. If it is more or less, you should give a reconciliation for that. That is another area of looking into that. Presentation of financial statement, Schedule 6 is talking about Division 3 for NBFC. That format basically on liquidation, liquidity basis, you have to use that liquidity basis of presentation, and disclosures required under Schedule 3, Division 3, as well as Companies Act 2013, accounting standards, RBI regulations, all these are required to be looked at by the auditors, and the validation of that also critical. I think that brings me to the time which has been allotted. I will be happy to take this questions. I will stop the presentation. This presentation I will share with WASB so that the participants can also use it. And I will be happy to take questions along with my co-speaker, Vikas Ji. Over to the moderators.
Thank you, sir. Thank you, Chinaswamy, sir, for the nice deliberation. Now we will quickly take up some questions. For the direct assignment transactions entered by NBFCs, what are the key points we need to be considered while auditing?
So, as I have already mentioned earlier in my talk, that for direct tax assignment, 2-3 important things, apart from whether it's a true sell or not. That is the first step which the auditor must do, whether it passes the definition of a true sell, that the risk and reward has been transferred, and hence this can go out of the books of the NBFC and can be treated as a sale. That is the first thing which the auditor must look upon. Second, as and when we treat it as a sell, then as I said, that whatever income is going to happen for the remaining period is something which this Ind AS allows you to recognize now. The question is that how and what we can recognize. So, as I already spoke earlier, the key thing first is the life, as to what life we are considering for that DA asset to be recognized. It cannot be that contractual life. Suppose I have given loan to somebody which is for 15 years. Now 1 year has passed, 14 years is left. Now I have sold this asset to, say, X. Now, for 14 years, the difference in the interest rate is something which I am eligible to. But whether this loan is going to continue for 14 years is not, is a question mark. So what is to be done is, based on the past trend for the company as a whole, or if they are dealing in such type of DA cases on a very, very regular basis, then this could also be that for DA cases itself, what is the past trend for that entity? And based on that past trend, you have to first determine the life. So generally, like as I was also talking in housing loan cases, the life is generally 5 years to 6 years as compared to the contractual life, which could be around 15 years or 20 years as well. So this is the life, which is the expected life which you consider. And you assume that the loan will be over by that time. That is the first assumption you should take. Second, what should be the discounting factor? So on that also I talked about that there are companies which they consider that what is their borrowing rate. They consider that as the discount factor. Whereas as per Ind AS, it is basically the risk reward. You have to see that what is the risk of the asset pool which you are selling. So if your asset pool is at 16% or 14% or 15%, the NBFC borrowing rate is 7%. The question is, can you do the discounting at 7% or you do the discounting at 16%? Third factor here comes is that you're selling that asset to XYZ at say 12%. So there are three discounting rates. One, your borrowing rate of 7%. Second, that pool itself you have sold for 12%. Third, your contractual rate is at 16%. So what rate you are going to use? So in our perspective, Dr. Ganeshan can also give his thoughts on that, because this is again a very important topic. So in my view, what is there as your borrowing rate is not the risk or reward relating to this pool. So that should not be considered. It should be either the rate at which you have lent the money or the rate at which you are able to sell that asset. Yeah, Dr. Ganeshan, your thought on this?
Thank you, sir. Actually, you have covered in depth what is the requirement. I just wanted to add upon only 2 points. One is the direct assignment accounting is normally not a routine business activity. It is outside the normal course of business, and accordingly, all the precautions which you have to do as an auditor when you are auditing one-off event, you have to look into as with all your professional skepticism, because we have seen in many cases that comes normally at the year end to ensure that your profitability and top lines are managed. The second aspect which you have to look at is the requirement of Ind AS 109 with relating to derecognition of financial asset from your books. There are some criteria which has been given, like cash flows, like risk and rewards of ownership, etc. And sometimes even cash collateral which you have given. Even though you have structured it, it may not be fit into the framework of direct assignment, and it will continue to be recognized in your books only. So these are all the additional points which you have to look into that. Otherwise, it's very nicely explained by Mr. Vikas.
Another question is, can an NBFC charge interest annually on loans given to its customers?
Sir, interest charge on an annual basis. To my mind, there is no restriction to charge interest on an annual basis. But the problem is the NBFC is normally committing based on an EMI, right? Monthly EMI, to ensure that the risk of credit is not going up. And accordingly, even though it's hypothetical, it is possible that you can have a bullet payment along with the interest, etc. But your accounting for the interest income should be based on the period which has been spent in the books of accounts. And interestingly, one more additional point, maybe Mr. Vikas will also add up something. Now, NBFCs have had some surprise reviews by Reserve Bank of India, where Reserve Bank of India is coming out heavily by saying that the rate of interest which you are charging it's a higher rate of interest. And accordingly, the way in which you have priced your product itself is wrong. So they are coming with penalty for those particular scenarios also. That is very commonly happening in the last 6-7 months. It is happening. And accordingly, normally a NBFC will go for a monthly interest rate or at the maximum quarterly, and not normally goes for a year-end annual basis. But to my mind, there is no restriction that you should not give it on an annual basis.
No, that's right. So just to add what Mr. Ganeshan has said, that there is no bar. I also do not think there is any bar. One can do that. But the main thing is you have to see whether it is driven by their policy, whether their policy allows that type of exception. So if you have structured a product which your board has approved saying this is how it is going to be this much loan you can give, this should be the minimum security, these will be the interest to be charged. There, if you say 5 people, I will not charge on a monthly but on a yearly basis, that's a question mark. Then that's like a non-compliance to the policy, and then it becomes a sort of restructuring or resettlement of the loan rather than giving in the normal course. But if it is not of those type of loans, but some specific loans to specific parties which you are giving, and you have designed it in a manner that they will pay on a 6-monthly basis or yearly basis, that should be fine. As an auditor, I will be definitely a little more concerned as compared to the normal loan because the amount is not coming on a regular basis. So I'll have to again focus more to see as a professional skepticism that whether my security is sufficient. There were logic reasons to delay that interest rate because say there is some construction loan which is given and now they will construct the residential property and then the realization will come later on. They are not launching it now. That's why they cannot pay. So if there are some logics which is built into it, fine. If there are no logic, then as an auditor, I will be worried.
Sir, another question is, can the interest on NPA loans be charged to the customer account and then a provision entry be made to reduce the interest amount from the profits?
I could not understand the question fully.
Once again, I repeat the question. Can the interest on NPA loans be charged to the customer account? And can a provision entry be passed to reduce the interest amount from the profits? There are 2 entries.
Right. So under IGAP, under IRAC norms, the moment the account becomes NPA, you do not charge the interest or you do not recognize the interest in the books of accounting. It becomes on a cash basis accounting, right? Whereas in Ind AS, there is no such bar. If there is sufficient security to the loan which you have given, even if the loan is NPA, you can charge that interest and you can recognize that interest in your books of account. And then you will see as per ECL norms what provisioning you need to do, including on that interest amount as per the ECL provisioning which is working out. So in Ind AS, it is permissible or it is rather allowed or it is expected that you will actually charge the interest even on NPA accounts if you have sufficient security available.
Next question is, what are Ind AS apply in audit of NBFCs?
Ind AS goes with a simple logic, sir. If NBFC is listed based on the listed criteria, Ind AS is the accounting framework which you have to, financial reporting framework you have to apply. If the entity is planning to go for IPO, then in that case also it should go for Ind AS adoption. And based on the net worth also, 250 crore or more, automatically they should follow Ind AS. So the Ind AS application for NBFC is based on the circular relating to application of Ind AS and not based on just an NBFC. So listed means all the NBFCs listed will automatically get covered. If it is an unlisted based on the net worth criteria, it will get covered. And the moment I say the financial reporting framework is Ind AS, all the Ind AS is applicable. There is no exception which has been given from any of the Ind AS standards.
Next, an interesting question is, how to cross-check when housing NBFC loans granted based on fake documents, no sufficient income proof, defective security cover, valuations, how auditors are responsible?
So as I said earlier also in my talk, that in NBFC generally, especially the retail NBFC, the numbers are such, it is so large that it is not practical even for you to even check 1% or 2% of them. Somebody is having 1 lakh customers, somebody is having 2 lakh customers. So it is very huge, right? What you are required to do, that you have to decide your sampling methodology first. Based on your sampling methodology, the samples which has been, number 1, sampling method is number 1. Number 2, how are you getting the sampling? Again, whether you have a random method or you have some scientific method, you are using some audit tool, how you are actually going to your sampling is a critical and important part in NBFCs. Once you decide on the samples, then that samples, for those samples, you must do end-to-end. Starting from how it was originated, what documents are there, is there any chance of anything being fake, KYC not being there, or security is stipulated but not created. Whatever other things must be seen and checked for all the samples which has been selected.
Thank you, sir. Over to Vinay.
Yes, sir. First question is, what do you think will be the impact of increasing risk weightage from 100% to 125% for NBFCs and banks for credit card loans and unsecured loans?
Ganeshanji, you want to answer this, or should I? You're on mute.
Relating to advances, you can actually pick it up.
Right. So, Vinayji, basically, if you see, RBI comes with the norms based on the requirement at that point of time, right? So in their wisdom, they have seen that the unsecured loans are increasing significantly. There are chances of default into it. Similar is the credit card, because that is also nothing but a sort of unsecured loan. And many banks were growing significantly larger in that area, banks as well as NBFCs. Their policies were determined to see that how do we get more share of that. The moment you start growing faster, and these being unsecured, you always have a larger risk in spite of your own processes and controls and other stuff. RBI was worried that this can create a systemic risk at some point of time. And in case if any NBFC or bank, they come across where they have not been able to do, or some people have not done properly, it can create a jittering effect in the entire industry. Accordingly, in their own wisdom, they have come up and increased this risk weight, which in my view was a good step, because it will help to cool the market a bit. It will help those NBFCs to really go back and see that whether they need to be similarly aggressive or they have to control further because the risk weight has increased. So it should be a good thing in the short term. In the long term, again, I think the moment RBI feels and realizes that the things are stabilized and better controlled, they will take further action on it.
This is also for Vikasji, for you. Any suggestion on auditing on NBFC that is lending via digital intermediary and having arrangement like FLD?
Arrangement like?
FLD, first loss guarantee. First loss deposit guarantee. Security deposit.
So I have to be very frank, not very clear on this question. What do they want to understand?
They want to ask an NBFC company lending through digital intermediary. I think earlier there is no guideline from NBFC regarding the percentage of portion from NBFC or intermediary. And now after the incident of some RBI made some norms regarding the FLDG, first loss deposit guarantee. And I think it is almost 30%.
Ganeshan, do you have any idea on this?
No, sir.
So we will forward the question to you. We will revert to the member later.
We will revert.
We can skip this question, Vinay sir. We will forward to the esteemed speakers. Then we will give the reply later, sir.
And the next question is, there is any NBFC whose NPA provisioning norms applicable 150 days instead of 90 days?
So that has been harmonized. Earlier, HFCs used to have different norms as per the National Housing Bank norms, where they were given, but RBI has harmonized that now. And I don't think there is anything which is going on days, except for agriculture loan, where it is not based on days, but it is based on the cycle of the short-term and long-term crop. So that's a different thing, but otherwise days are the same for all.
Okay.
Just to add, there is an RBI circular on how you have to fix up your stage 1, stage 2, and stage 3. There they are saying that based on the business model of the entity, you can define what is stage 1 and stage 2. But the disclosure is in accordance with 30 days and 90 days now. That's the way in which they have specifically mentioned. Maybe the provisioning can go for a different buckets to arrive at your expected credit loss based on the business performance, but the disclosure has to be in accordance with the RBI norms.
Next question is regarding the appointment of auditor. Is there any cool off period for base layer NBFC?
Sorry, sir, come again.
This is a question regarding the appointment of auditor. If there is any cool off period for base layer NBFC?
That's what they have mentioned, that 3 years is the period for which an audit firm can be appointed as statutory central auditor. And they have said that 6 years is a polling period for getting the audit of the same NBFC for the next term.
So I think the question was that for base layer, which is less than 1,000 crore, whether this cooling off period of 3 years will be applicable to them. I think Ganeshan ji has covered in his presentation also that this is not applicable for less than 1,000 crore. This 3 years and 6 years cooling is only for NBFCs beyond 1,000 crores.
Correct.
Only what they have said, when you are seeing the number of 8 NBFCs there, they have not taken the criteria of 1,000 crore or less than 1,000 crore. For seeing that, it is included, but for other purposes, 1,000 crore and below is not included for the 3 years and 6 years.
Correct.
The last and not the least, in FFC, HFC, what is the auditor rotation norm, audit firm wise and engagement partner wise, both limit? Please explain in short.
I think it is the same which Dr. Ganeshan has explained, that it is 3 years and 6 years. It applies to NBFCs and HFCs both. Only difference, I think, what he's trying to understand earlier, when our appointment used to be for 5 years. At that time also, there was a specific requirement of engagement partner rotation after 3 years, as per RBI norms. So even at that time, even if your appointment was for 5 years, the partner rotation was required after 3 years. But now, since the appointment itself is for 3 years, so there is no question of further engagement partner rotation or anything.
But the only point which we have to take into consideration is based on, again, the regulators on audit profession is coming up, is the engagement quality review partner concept. So for a listed company, it is mandatory. And accordingly, when we are talking about listed company series and the NBFCs as part of that, other than engagement partner, there should be an engagement quality review partner also. That engagement quality review partner, how robust the system of the audit firm in appointing the EQCR is also very important, and that has been questioned by the regulators, and accordingly the policy of the firm or the audit manual should be very, very clear on how they are actually looking into that.
Thanks a lot, Vikas ji and Chinmay Swami Ganeshan ji. Over to you, Anil ji. Thank you.
Thank you, sir. Thank you so much.
Thank you.
Now we come to an end. On behalf of AASB of ICI, I extend my heartiest thanks towards both the learned speakers, Vikas ji and Dr. Chinnaswamy Ganeshan ji. And hats off to you, sir. You have covered all the aspects of covering of auditing of NBFC. And in spite of having busy schedule as well as the audit committee meeting season, and you have given your kind consent, both of them have given their kind consent to deliberate for our members. So thank you so much, sir, from the core of my heart, as well as on behalf of AASP of ICI, for enlightening all of us on various intricacies in the audit of NBFC. And thank you so much, Vikas ji. Thank you so much, Dr. Ganeshan ji. And we are having with us both two senior members, CA Vishal ji and Vinay ji. Thank you so much, Vinay ji and Vishal ji, for wonderful coordinating this webinar, today's webinar. And this is the coincidence, we are having 3 V's today. Vishal ji, Vikas ji, and Vinay ji. And 3 V's we are having. So it is a victory of our this webinar headed by Dr. Ganeshan ji. Dr. Ganeshan ji is also there. So it is a very good webinar today. And we have learned a lot through deliberation of Dr. Ganeshan ji and Shri Vikas Kumar ji. And thank you so much once again, Vishal ji and Vinay ji, for giving your kind consent to moderate this webinar. I also thanks all the participants.
Thank you, everyone. Thank you so much. And thanks to all the participants as well. Thank you.
Thank you, sir. Thank you so much, sir. Thank you, sir.
Thank you, Anil ji. Thank you,
Thank you, sir.
Thank you, Vinay. Okay. Well done.